All right, people in the class, very good morning and welcome to the session. Welcome to lecture 3 of CA Final AFM Full English batch for the attempt of November 24 and onwards. Everyone, are you people there? Are you able to see me, hear me? Very good morning, everyone. क्या हाल है आप सभी के? How are you all? All good? Good morning, good morning, good morning. So we'll wait for a few minutes for people to join in and then we start our discussion. All right. So just wait for a second. Sahil, very good morning. Rest of the people in the class, very good morning. Are you people all good, all set? What's going on? How was the weekend, by the way? What did you do Saturday and Sunday? Was it good? One second. Huh? So, how was the weekend? Study, sir. Tell me the truth. You must be sleeping for 9 hours or 10 hours or even 14 hours a day. Sahil, or genuine studies. All right. So can you people please help me recollect what was the discussion we had in the last lecture? So in the last lecture, if you recollect, I made you people understand about dividend valuation models, where we consider dividends of the company to find out the value of the share, where the underlying thought was value of a share today is the present value of all future cash flows generated from that share, which means present value of all future dividends to be received from that share, where we had two possibilities in front of us. Possibility one, when you have definite number of years, right? So in that case, you do manual discounting. You do discounting of dividends of next few years, and at the end of that period, you will also receive the sales price. So present value of dividend and present value of sale price, when all of them discounted by KE, give you the value of share. Similarly, if you want to find out value of share in case of infinite number of years, which means there is no timeline which is defined, which means we have to consider the dividends till infinity, everyone. And when you have to do so, we used to do it using dividend discount models. Irrespective, when you do discounting of dividends, you need cost of equity calculation, for which we had read three priorities, right? Three preferences in which we can calculate the KE. Once that was done, we understood that, sir, depending upon the pattern of dividend, we decide a model. If the dividends are constant, there is no growth in the dividend, you do present value as D1 divided by KE, which means I can either find out price today or I can find out intrinsic value today. Both can be used interchangeably if the share is fairly valued. All those things we have read in the last class. So if that is the case, if I have to find these out, dividend of first year divided by KE used to be the value of the bond. What is this formula doing? It is very important to identify rather than mugging up the formula, which is what we are completely against. Never mug up, right? Unless it is a pure maths formula behind which common sense could not be found, right? So if you want to do if you apply this formula, what is this formula doing? It is giving you the present value of all the dividends from which point to which point, from D1 to D infinity. Is it also adding D0 to your present value to this price? No, it is starting from D1 till an infinity. This is the clarity. Next, we went to Gordon's model. Similarly, we said D1 divided by K minus G. where there were a very few, where there were certain important points to discuss. One, official formula is D1. You cannot do D0 into 1 minus G primarily. If you don't have D1, then you do this. Otherwise, you don't do this. First. Second, when you talk about KE, it is completely clear to you how do you calculate KE. Three preferences. When you talk about G, it is very important to understand you talk about the growth of dividends. Acha, G is officially called as sustainable growth rate, right? Which is the growth rate of dividends? Which is growth rate from which point to which point? Sir, it is from D1 to D infinity. Because to your calculation, the first number that matters is D1 and the last number that matters is D infinity, and the growth rate between these two numbers is what is considered in the formula. Sir, sometimes examiner might give you the growth of earnings and not growth of dividends. So if payout ratio of 2 years is constant, then growth rate between the earnings and dividend of those 2 years is also constant. However, if payout ratio changes in a particular year, right, if the payout ratio of 2 years is not same, then the growth of earnings between those 2 years will not be same as the growth of dividends. How many of you are able to recollect certain basic things that we had done in the last lecture? Requesting your responses, everyone, please. Are you people set? Are you people set with this conclusion? Everyone? Super quick. Because I can understand in the period of last 2 days where you get a Saturday or Sunday, you sleep so much that you tend to forget what was there in my life on Friday. So I want to bring you back to this point. Everyone, are we all ready for this? So let us now speed up to solve further questions and understand more concept. We are done with the formula of growth, right, which is retention ratio into ROE. We are all set till this point. Now let me take you to outscanner. If you talk about outscanner, everyone, we were done till question number 3. Now let me take you ahead. Question number 4. An extremely easy question is needed to be solved only and only on calculator. Let us do it. People in the class, let's start this discussion. Open your calculators and we'll start to do this. All right, come. Everyone, please be here. Following are the details of X limited and Y limited. All right, just hold on for a second. Hold on for a second. I need to do something. Just a minute. Cool. So question number 4. Everyone in the class, I want your energies for this to be solved, which is a very easy question. People, please be here. All right. So following are the details of X limited and Y limited. All right. In fact, I must say this question can be solved by you yourself only, right? But let us try to it once. Following are the details of X limited, Y limited. What is the dividend per share? 4 and 4. Sir, what should this dividend be considered? In the absence of any information, we should always consider your dividend to be D1. All right. And this is not every time institute would do it, but most of the time it would do so. So let us check. Sir, what is the growth rate? 10%, 10%. What is the beta? 0.9 and 1.2, right? Current market price is 150.70. What do you have to do? Other information of risk free rate is 7, market return is 14. I want you to have 30 seconds to quickly reread what is there in this question. Everyone done? Sahil done? I want you all to reread in 30 seconds to understand what all information is given. Calculate the price per share of both the companies. Sir, price is already given. So obviously what you calculate is intrinsic value. To calculate intrinsic value, since information of dividend is given, you will apply dividend discount model. Since the information of growth is given, you will apply Gordon's model. So let us apply Gordon's model. What do you need? Sir, D1, KE and G. Do you have D1? 4 can be assumed as D1. Do you have KE? Sir, CAPM will have to be applied. So RM minus RF and 2 beta. So 14 minus 7. Use your calculator very quick. Quickly use your calculator. So 14 minus 7 into 0.9 beta plus RF again gives you CAPM, gives you cost of equity KE of 13.3. Where is my calculator? I cannot see it. Chalo, anyways, let me do it over here. Hold on. So 14 minus 7 is equals to into 0.9 is equals to plus 7. 13.3, everyone is K for the first share. Alright, what is the growth rate? 10%. So if I do D1 divided by K minus G, 4 divided by 0.033 gives me 4 divided by point should be 033. 121.21 is the intrinsic value. So obviously this part was quite easy, which is why I did not make you people do it in the notes. What is more important for us to understand is this. Write the comment on the valuation on the basis of price calculated in current market price. There is one price which you have calculated and there is this price which is already there in the market. On the basis of this, can you comment on the valuation? Please tell me, everyone needs to answer this question. Sir, price in the market is 151 and price according to me is 121. Can I say my share is undervalued? Price as per me is lower. Can I say my share is undervalued? Everyone quick, yes, no, I need a response. People, the answer is no. No. You never comment on the price which you calculate. Always remember, for the entire AFM, you comment on the price which is there in the market. Share X is not undervalued because what I calculate is what should be the price. The price should be 121. What is the price is 150. So comment on 150 and say if it is overvalued or not. Don't comment on 121 to say it is undervalued. Are you please understanding? Basic things where a student can miss. Sahil. Rest of the live people in the class, recorded people, are we set with that? Yes. So current market price 150, you will comment it is overvalued. Similarly, if you talk about Y limited, acha chalo, let me continue. Y limited you can do at your own. Next, as an investor, what course of action should be followed? So common sense, if a share is undervalued, what do? You proceed to buy it. If a share is overvalued, what do? You proceed to sell it. In our case, since the share is overvalued, we are going to sell it. We are going to sell it. So it's not that it was something which you can't imagine. But for the first time, we did something like undervalued, overvalued. And I would want to make sure that we write down such things in the handmade notes. All right? Handmade notes as in out notes. Can you please, everyone in the class, come to this page number. On page number 11, let us try to create a small table kind of a thing. Y'all please wait. Let me create and then you write down. So we will say, comment, always comment on the actual price in the market. So which is why I always write CMP first. If CMP is more than intrinsic value, if price in the market is less than how much it should be, then the share is undervalued, in which case we should sell it. And if both are same, the price in the market is same as how much it should be, which means the share is fairly valued. Let me tell you, even if the share is fairly valued, one can buy it. Tell me one thing, according to you price of share should be 1000, and if it is 1000, obviously you're gonna buy it, right? What is the problem? Despite theoretically institute always says, sir, hold it. If you think a share is fairly valued, you can continue to hold it, whereas practically you can actually buy as well if that is the case. Are you people understanding? So this was a small thing which I wanted you people to write down. Kindly update in your notes. Cool. Shreya, very good morning everyone. So this is done. All right, let us move to next discussion. Question number 4 is done. Question number 5, extremely easy question. You will have to do it in the form of homework. Question number 5, extremely easy question. Question number 6 is a good question, can be done in the classwork. Everyone. Question number 6. Please be here. Very quick classwork. Needs to be done. Let me check. Needs to be done on the notebook. Quick. Everyone, let's come to question number 6. Let us start reading. We'll do it in the notebook. Share of Voyage Limited are being quoted at a P ratio of 8 times. Sir, what does this line mean? This line means that there is a company in the market, right, whose P ratio is 8 times. Sir, why do they say that share is quoted at a P ratio? Share is quoted at a price, not at a P ratio. But sir, if you look at it, what is the numerator of P ratio? Price, right? Which is why it is can also be said that share is quoted at a P ratio. Alright, 8 times is the P ratio. The company retains 5 rupee per share, which is 50% of its EPS. Oh my god, so simple. Company has 5 rupees as its retained earning per share, which is 50% of the total EPS, which means EPS of the company is rupees 10. All right. You are required to calculate cost of equity to the company if market expect a growth rate of 15%. Oh my God. This time, everyone in the class, this is not a question of valuation. Rather, this time they are asking you to calculate KE. Think about it. Have I taught you certain preferences in which KE should be calculated? If yes, try and think, everyone. Which preference do you think can be applied here? Preference 1, 2 or 3? I'm giving you 30 seconds, everyone, to think in the class. Recorded people, you can't sit this way. Think. Shreya, are you still here following us? Are you still here following us? Can preference number 1 be applied? Obviously, no, there is no RMRF. Can preference number 2 be applied? This is the most important part, sir. Please remember, preference 2 was D1 divided by P0 plus G. K is equals to D1 divided by P0 plus G. Now tell me, if this is the preference, first we will need to make sure that we are able to find this. If we don't find this, then we have to go to third preference, which is earnings yield, which is 1 by P. Sir, do you have D1? Sir, if I have 5 rupee as my retained earning, which is 50%, then obviously my EPS is rupees 10 and obviously my DPS is also 5. Of the entire earning, 5 retained, 5 distributed, we are sorted with D1. Divided by P0. Is it possible to find out the price? Think everyone in the class. Very good question. Like small things. Sir, is it possible to find out P0? What information do I have? I have an information of P ratio. Think. Sir, can I do PE into EPS is equals to MPS? The very second formula of the basics of AFM that you read in the class, P ratio into EPS is MPS. So how much will be the P ratio? Sir, 8 times of P ratio into EPS of rupees 10, matlab MPS of 80. Cool. Plus growth rate of 0.15 has been specifically given. Now are we in position to find out answer of part A? Yes. So always remember, everyone in the class listen to this very carefully. Always remember that before solving a question, you should be there with the question for 30 seconds. Try to imagine the steps. Try to imagine what all working notes would you need, and then ultimately start writing and apply the formula, so that you don't have to do you don't have to cut the solution in between and redo and things like this. All right, come here everyone in the class, let us very quickly start writing. Question number 6, I will dictate and you will have to write. You know now the flow of our class. Cool. Let me chalo. Let's start. Everyone, let's start. First, how much is EPS? Sir, it is rupee 5 divided by 50% is equals to rupees 10. Sir, why are you not writing down the formula? As I said, now you people are since comfortable with such basic things. We don't need to write down the formula. We have done it in yesterday's session. How you are supposed to do in the exam hall is this. You don't have to worry about writing down the formulas. All right, next. Sir, DPS dividend per share is equals to rupees 10 minus rupee 5 of retained earning. In fact, you can remove the word rupee from here, as I said. In the calculation, you don't need to show the word symbol of rupee. 10 minus 5 is equals to rupee 5. Sir, what is MPS, which is actually P0? That is EPS into P ratio. Sir, how much is EPS? 10 into how much is P ratio? 8, which gives you rupees 80 as MPS. Sir, what is the growth rate? Directly given in the question as 15%. Using the 3 information, can I calculate KE? Yes, this is an official formula you will have to always write down. Sir, given dividend, what should it be assumed? D1 or D0? With the language, the company retains. When they say company retains, we are not clear if the company has retained or company will retain. We are not clear with the past or the future, and when that is the scenario, what do we have to do? We have to consider it to be the D1 when it is not clear. Sahil, all the recorded students, all the live students in the class, give me an answer. What will be the answer of KE? People, very quick. Answer of KE without me explaining anything to you now. 21.25 everyone is the answer. 21.25%. Basic, easy, sorted. Next one. The indicative market price. You are required to determine indicative market price if same cost of capital and the growth rate is 16%. Sir, in the first part, they have given you this price. Basically, P into 10, 80 of price they have given, P into 10. In the next part, they are saying that if the growth rate changes to 80%, 16%, sorry, rather than 15%, if growth rate changes to 16, will the price change? Obviously. If you imagine the formula of price, imagine Gordon's model, it is D1 divided by K minus G. If this growth rate will change to 16, will your price change? If yes, what is that indicative price? Understand the meaning of the word indicative price means intrinsic value, fair value, equilibrium price. Alright, very quick question, part 2 of this question. Second part of this question. P0 divided by K minus G. D1 is how much? Acha, let me confirm the answer to first part. It is set. Divide by how much they gave us K. How much is calculated? 0.2125 as we have calculated in the first part. Now we have K, right? Divide minus 0.16. Kindly calculate the price quick. 0.2125 minus 0.16 is equals to this multiplied by 5. 95.24 on a rounded off basis. We will say rupee 95.24. Those who are writing 95.23 as the answer, live people, recorded people, Sahil, I can purposefully see that. 95.23 if we write down as an answer in the exam, and if the examiner deducts the mark, then we are not, like, as in, if they, in that case, examiner is not wrong, he's correct. All of us know the basic rounding of rules we should follow. If the answer is 95.238, it should be 95.24 is what I'm trying to tell you. Cool, everyone. B part gets done. C part ultra quick. The price per share if company's cost of capital is 20% and anticipated growth rate is again 18%. I'm giving you 30 seconds to solve this. I won't do it in the class. Very easy. Recalculate the market price. You have a newer K and you have newer G. What else is there? Simple, you have the number of D1. Quickly calculate price at your own in the notebook itself. I'm giving you 30 seconds to do it. Do it right away. Chali, so we have 95.24 as the answer already done. In the third case, it is 250 as the answer. Let me tell you one more thing. We'll follow it later on, but for your reference. If the same formula is used multiple times in the question, we don't need to write down the formula again and again. You have written it down here? Fine. You don't need to write it down again in the third part. If you write it down, no problem, but there's no need to do so, is what I'm saying. Alright, cool. So I want you all to be there in the outnotes for a moment. People, on page number 10, so we will try to make sure that we update everything in the outnotes, which means the book that you create, that you have, should be so complete that beyond this book you don't have to refer to anything. Please come to question number 10, and at this point where you have written intrinsic value, let us write down alternative words. What are the alternative words? Fair value, fair price, equilibrium price. Someone said in this question, as they said, intrinsic, indicative value, indicative price. If you feel like writing here, you may write down, but that is not an official word actually, right? So this is also sorted. Let us move to very next question. Let us figure out where do we stand. All right, hold on for a second. Great. Question number 7th is actually a very good question. Let me check. 7th is there, 8th is there. Question number 9th is surely to be done in the class. Question number 7 and 8. Question number 7 you will do at home. People, kindly mark question number 7 as homework. Very good question. Literally very good question. All right. Question number 7th. In this question, you will have to try at home, but one thing I want to explain. This question, in this question, I want to teach you something which is mathematical in nature. Logically, you are all set, you know everything, right? For example, the last paid dividend on this equity stock was rupees 2. It is very clear. Last paid dividend, matlab the given dividend is D0. First thing is clear. Everyone in the class. Rest of the things you can crack at your own. Sir, second part is again important. In the first part, they have given certain information that if this is RF, if this is RM, if growth rate is this, they have given the information. But in the second part, they are changing those informations. Let me explain how the effect of change in information given. How would the equilibrium price, which means how would the intrinsic value change when inflation premium increases by 2%? This is what I want to primarily teach you. Inflation premium increased by 2%. You people tell me, if inflation premium increase by 2%, what all will increase? Will your RM change? Will your RF change? Will your growth change? What will change from the given information? So let me tell you. Can you please recollect the basic? I said your required rate of return has two components, three components actually. Real risk-free rate, inflation premium, and risk premium. Right? Which means, can I say inflation premium is a compulsory component of all the rates? If the rate is nominal, how many of you are able to recollect? Don't want you to take you to that page. If you want to go to that page, pause the lecture and go there, but I won't take you. You'll have to imagine with me. If the rate is real, which means there is no inflation premium in it. But if the rate is nominal, there is always a component of inflation premium. Correct? Since the given rate is a nominal rate, unless examiner says anything, we always assume the rate to be nominal, because what prevails in the actual world around you is nominal. Since the given rate is nominal, then inflation premium is a part of 9% of RF and also 13% of RM. In fact, the difference between RM and RF is that risk premium component, as we learned in the class. Which means if this increases by 2%, RF will become 11, RM will become 15. First thing. Second, growth rate increased by 3% that you do, beta rises to 1.3, which means right now it is 1.2, you have to make it now 1.3. An effect of all these three things you have to give simultaneously. These are not three different parts to be solved. Sahil, set. So question number 7 that way gets done. Question number 8 is a good question we will do in the classwork. Not notebook, but classwork. Please be here. Question number 8, everyone. X Limited just declared a dividend. Oh my god, look at the language. Just declared. It is D1. Mr. B is planning to purchase share of X Limited, anticipating that the growth rate will increase from 8 to 9%, which will continue for 3 years. Alright, fine. He also expects the market price of share to be 360 after 3 years. He is planning to hold the share for 3 years, during which the growth rate he is estimating to be 9% and the price at the end of 3 years is 360. Looking at this question, what can you recollect from the outnotes? Apply your brains, try to recollect what can you think of it from thing related to this question from the outnotes. Which concept is it giving you hint towards? Everyone in the class, are you able to recollect definite number of cash flows? Please. Life is 3 years, which means definite number of cash flows we have. The maximum amount, you are required to calculate the maximum amount Mr. B should pay for share if he requires a required rate of return of 13%. So if I need a required rate of 13%, which means I will discount my cash flows at the rate of 13%. What are my future cash flows? Sir, my future cash flows are dividend of 3 years and the price of 360. Use your calculator. Sir, what is the dividend? They have just declared 14 rupees. What is the growth rate? 9%. What are the future value factors given at the rate of 9%? These are the factors given. Let me tell you, if examiner gives you factor, you should never use the factors that you calculate. Clearly follow what they have given. Alright. Now let me also guide you how can I present it. You can present it in two manners, either table or equation. If it would be table, how will it look like? Let me show you. If it would be a table, basically it will look like year, dividend, or sales price, present value factor, DCF. Year 1, 2, 3, 3. Sir, why 3 2 times? Because third year we have dividend. Don't write it down, just understand me once. Because third year you have dividends and third year you have sales price. Sir, what will be the dividend for first year? So it will be 14 into given factor of 1.09. What will be dividend of second year? 14 into 1.188. Third one is 14 into 1.295 and sales price is 360. Then I write down the present value factor. Have I been given the present value factors, people? So what is the required rate of return? 13%. Which means, do you agree? I have to do present value of future cash flows. These will be my future cash flows. If I have to do present value, obviously I'll have to discount them by 13%. So do I have the present value factors given for 13%? Yes. You can use these rates directly. Whatever will be the amount of dividends and sales price be there will have to be multiplied by 0.885, 0.783, 0.693 and 0.693. And once you get the DCF, sum of the present value of cash flows will be the value of share. This is tabular way of presenting the things. Otherwise, you can present it in equation which does not look very good. So let me show you how will it look like. Let me first of all see what has examiner done. One second. The screen is stuck. What is examiner done? Even examiner has prepared a table because the presentation looks cleaner. Otherwise, what we would do? We would say present value. Now imagine that. Otherwise, what will I say? Value of share. Alright, I will say P0 will be what? Sir, what will be D1? 14 into 1.09. And what will be the present value of that D1? So you should be able to imagine this common sense. Do you agree P0 will be D1 into present value factor of first year plus D2 into present value factor of 2 years plus D3 into present value factor of 3 years into P3, price at the end of third year, sales price at the end of third year into present value factor of third year. Now, what will be D1? D1 will be 14 into 1.09 with growth multiplied by 0.885. What I'm trying to tell you is that formula driven presentation does not look good if there is too much of information. Tabular presentation looks good. Formula driven presentation can be done if so overall it is less preferred. Let me not complicate it for you. Let's keep it simple. If there would be a situation where formula driven presentation is needed, I'll explain you at that point. Right now there is no need to imagine this. Kindly answer. Sahil, are we set with the presentation? Are you okay? Are you okay with that? Rest of the people in the class, live people, recording people, can we proceed? Yep, chaliye. Let us be very quick now to solve the questions. Sir, maximum amount we can pay. We have understood the entire concept. We just need to do the calculation. My dividend of first year will be 14. Where's that 14? This multiplied by the growth rate into 1.09 multiplied by present value factor 0.885, which gives me the cash flow of 13.50 for first year. Let me tell you, you don't need to write down for 4 digits. You can make it 13.51, 02 and 04. Just keep it for 2 decimal points. All the cash flows 2 decimal point, present value factors 3 decimal points. Simple. Alright, let us proceed. Second one, 14 rupees dividend, growth of 2 year multiplied 1.188 multiplied by present value factor into 0.783 gives me 13.02 as the cash flow. And third one, do it where the sales price will be 360. Finally, give me the answer of PV. Waiting for the answer. Everyone. Use your calculator. So one thing I need to make clear. Do you agree answer is already there in front of us? If I have to look the answer, I can directly see at it. Problem is, I don't want to look at the answer, I want to solve it. This is what you should be thinking. You want to solve it. We are sitting in here so that you can look at the data given in the question and solve it in the calculator at your own. Are you people understanding? There cannot be any compromise, slightest of the compromise in solving the question in the class or at home. Simple. There is no explanation or excuse or alternative to that. The one thing which I cannot accept any compromise at all is this. Am I strictly clear? Because if you are not doing so, you may please claim refund and don't watch the classes further. You may not pass if you do so simply. But if you solve it in the notebook, you will surely almost pass, because we are learning with that clarity and with that detailing. 14 is D1 or D0? Let us read it again. X Limited just declared the dividend of rupees 14. Sahil, you have just declared it. Thank God you asked it. It will be helpful to all the students to understand if anyone else is getting confused. Sahil, let us imagine on the timeline. D0 is today's point where we stand. D1 is next year for us. So today when we stand, if we say company will declare, it is D1. But company just declared, company has declared, just declared, paid, which means it has happened, which means it is D0. We are talking about the past, not about the future. It cannot be D1. Could I please explain this to you? Everyone else? Right? So fine. Second part, please. Second part, please. So do we have the answer of 288.57? Just a minute. I am. Chalo, cool. Second part, please. Extremely easy. Solve at your own. I'm not going to explain anything. Solve at your own second part, and I just need an answer. Sir, D0. If you read at the question, you will see that they are talking about indefinite growth, which means Gordon's formula, where growth is 9%, 13% is KE, this is D0. This time you will have to apply D0 into 1 plus G. As you people are saying, 381.5 is the answer, nothing out of the world. Part 3 is what I like, which is why we are here for this question. The price of the share at the end of 3 years, you have to find out. You have to determine the price at the end of 3 years if the growth rate of 9% is achieved, assuming other condition remains same as part B above. सर पार्ट बी में आपने बोला था शेयर 9% तक इंडेफिनेटली ग्रो करेगा, जहां मेरा रिक्वायर्ड रेट ऑफ रिटर्न 13% है. फाइन, 3 साल बीत चुके हैं, अब मैं थर्ड ईयर के एंड पे खड़ा हूं. टाइमलाइन पे जिस स्टूडेंट ने इस क्वेश्चन को समझ लिया उसको कभी कोई डाउट आने ही नहीं वाला है. सर हम पहले यहाँ 0 पे खड़े थे, जब 0 पे खड़े थे हमारा डिविडेंड 14 था, अगले 3 साल डिविडेंड ग्रो किया होगा, राइट. और हम यहाँ अब थर्ड ईयर के एंड पे खड़े हैं, यहाँ पे शेयर का वैल्यू पूछा है. सर कैसे पता अगले 3 साल डिविडेंड 9% पे ग्रो किया था? देखो लिखा है ना, प्राइस थर्ड ईयर के एंड. Oh my God, I'm so sorry. I think I have used a line or I think last few lines in Hindi. Hold on, I'm re-explaining it. If you are able to imagine this on the timeline, the question becomes easy. Sir, where did we stand initially at point 0, where my dividend was rupees 14, and my dividend in the last for the next 3 years have grown, dividend has grown by 9%. Sir, how do you know that? It's clearly written the price of the share at the end of third year. You have to find out if, so obviously you have to determine this, put a comma over here, put a comma over here. If 9% growth is achieved, which means if I've been growing by 9%, then you have to find out the price at the end of third year. Now, do you realize when you are finding P0, we used to take D1 divided by K minus G. Now, when I stand here, obviously I'll have to take the dividend of further next year. So at the end of third year, if I stand, I will say P3 will be D4 divided by K minus G. Are you people understanding the fact that we need D4 for the calculation now? So if you have D3 as 18.13, D3 is already there with me. Has examiner given to me the present value factor for 4 year? No. If I have D3 available with me, can I say D3 into 1 plus G divided by K minus G to find out the P3? People in the class, quick. So do this presentation rather than D4, write D3 into 1 plus G. What is D3 given to us, available to us? 18.13. 18.13 into 1.09 divided by K minus G, as we know, 13% and 9%. Quick. People in the class waiting for the answer. Whatever was needed to be explained from my side, I've done. So 18.13 into 1.09 divided by K is 13%, G is 9%, divided by 0.04. So 494.04 is what I'm getting as the answer. Isn't it 494.04? Please confirm. 18.13, as I can see, into 1.09 divided by 494.04 is what I'm getting as the answer. Please confirm. Right. So question number 8 with that gets done. The point I wanted to teach you in this question is particularly this, that if I have to find out price for a future year, so basically I have to take the dividend of further one, like ahead by one more year. If I want to find out D3 price of third year, I will have to take the dividend of fourth year, for which I have to simply add the growth of dividends. As we have done in this question, I have taken D3 and added growth to it to find out D4. Requesting your responses, people in the class. Are we clear with this question? Question number 8. Everyone. Are we people all set with question number 8? Kindly confirm. Everyone. Let's move on to the next question. So basically we have now back to back a lot of questions related to Gordon's model. Question number 8 we have done. Question number 9 is actually a very good question, a different one. Let us proceed to solve question number 9. Whether we have to write it or not, we will figure out, but we will do it in the class. Please mark question number 9 for the class. We are doing it out here. NM Limited is aspiring to enter capital market in 3 years' time. Is aspiring to enter into capital market. Sir, what is capital market? Basically this equity and debt market. So they want to enter into equity market by basically listing themselves. Okay, fine. The board wants to attain a target price of 70 at the end of 3 years, which means they stand today. They want to list them at the end of 3 years. And they want a share price of 70 at that point. Fine. The present value of share is 52.03. Right now, the value in the market is 52.03. Cool. The dividend is expected to grow at the rate of 15% for the next 3 years. What is the dividend right now? We don't know. But that dividend will grow at the rate of 15% every year, that we know. Fine. NML uses dividend growth model for its projection, which means we have to use dividend discount model for our calculation. Required rate of return is 15%. One second. Growth rate is 15% and even the required rate of return is 15%. Fine. Fine. If the timeline is clear, let me now take you to the question ahead. I'm removing this timeline for now. Okay, fine. You are required to calculate amount of dividend to be declared by the board in the base year so as to achieve the target price. If you want to achieve the target price of 70 at the end of third year, where the price of 52 is already there today, how much dividend should I declare in the base year, which means in the base year today? Sir, this question feels incomplete. Think. I will anyways guide you. I want you all to first listen to me and then I will give you a time to think. Sir, what is question trying to say? I want to achieve the price of 70 over here. Cool, which is fine. One way you can think is that, sir, price of the share depends on the future cash flows. What will the price at this point will actually depend on the future cash flows, because value of a share today is the present value of future cash flows. Sir, what will be the future cash flows after that point? Not given. This is so when I saw this question in May 21 for the first time, I really found this question with a discomfort. I thought the value of a share at any given point is depends on the future cash flows. So if the price should be 70, the examiner should give us future dividends. It has not. Then what has it given? It says that right now the price is 52.03. We said fine. How much should be the dividend to be distributed at this point? How much should be D0 such that if that D0 grows by 15%, my this particular target price is achieved. Question has given this information, which means I have decoded the language of question into this timeline. How to solve it now? I want to give you the time. And before you start to think, let me clearly tell you. My objective in the class is not that you solve so many questions. My objective in the class is you are able to learn how to think, which is why, rather than blindly teaching every time, I want you all to have the time to think about it. Do it, do it, do it. Think, evolve, think. How can we do it? Just a minute, let me have water. Everyone, have you tried to think? People in the class, 1 second. So what is the problem with this question? Let me clearly tell you. If you read at the language, you see that we want to maintain a target price of 70. But what we have to find out are not future dividends. What we have to find out are the past dividends. So in that case, you have to realize that we have to simply think it as you have been given P0, right? What is P0? Present value of future cash flows, which means this P0 should be equals to present value of D1, present value of D2, and present value of D3, and present value of this sales price at the end of third year. All these cash flows, all these four cash flow over a period of 3 years, when you discount them to 0.0, the answer is 52.03, which is already there with you. Which means using this data, can I back calculate how much should be D1, D2 and D3? Because I know now that D1 is D0 plus 15%, D2 is further 15%, D3 is further 15%, which means this is a simple calculation of back calculating the things. In your entire AFM, there can be only two ways a question can be asked. If they ask, one is they ask you a direct question that simply like as we were doing all the questions so far, that these are your dividends, these are your future prices, calculate the PV. Simple. That is what we have been doing. But at any point, if you feel that, sir, this is not happening, then always remember, I'm telling you something out of the box. Always remember that, sir, using the same formula, if this is not the question, suppose this is the question, so formula will not change. Formula remains the same, present value of future cash flows, but the inputs of the formula will change. This time you have the present value, you have to back calculate D1, D2 and D3. Same formula, no new logic, same formula, the components of the formula, I mean what you have will change and what is asked will change. Simply replace what is given with what is asked. Simply. All right. So let us proceed. Sir, if I assume the base year dividend to be D0 and I know that dividend will grow by 15%, then if D0, if I assume the base year dividend to be D0 and my growth rate is 15%, then can I say D1 will be 1.15 into D0? D2 will be 1.15 square into D0, right? And D3 will be 1.15 cube into D0. Do we have the dividends of next 3 years? Yes. What is the price that we want? 70. If I discount all four cash flows using this present value factor given in the question, I should get the price today, which is already given to me as 52.03. So let me present everything in the form of equation. People, you can see this. We need to make the presentation better. All right, hold on. Hold on. I'm trying to make the presentation better. You may actually cut this. Let's make the life simple. 52.03 is equals to D0 into 1 plus G, which is D1 into present value factor of first year, D2 into present value factor of second year, D3 into present value factor of third year, plus sales price of third year into present value factor of third year at the rate of 15%. Cool. Which means price of 70 into 0.6575. So we don't need to blindly follow institute solution every time. Whether you solve like this or you solve like this, ultimately the answer will remain the same and institute is going to give you the marks. Will you please hold for a minute? Can you listen to me? Yeah, sir, let's do one thing. Let us solve this, then you remind me, I will tell you how does institute allot the marks. It is very important for you to understand as a student. Otherwise, you know, right? If you know, you will solve the question accordingly. You will be smart to figure out whether I should solve this way or this way. All right, let me now show this to you. Present value of future cash flow, simple equation where my last cash flow is S3 into present value factor of 15% and 3 years. So those students who are brilliant would automatically realize that, sir, one side we are compounding by 15% because that is 1 plus G, and at the same time we are discounting by 15%. Which means, do you realize this will be ultimately nullified by this? If I compound my D0 for 2 years by 15% and discount it back again by 15% for 2 years, which means the effect is nullified, and even here the effect is nullified. So if you realize the net of this will be D0 plus D0 plus D0, you can check it mathematically, numerically as well. See this. 1.15 multiplied by, what is the present value factor given to you? 0.8696. 0.8696. Use your calculator. People in the class, pick up the calculator, quickly try it. Subject to rounding off, the answer has to be 1. 1.0004. So considering 2 decimal points, 3 decimal points, the answer to this is 1. So basically D0 plus D0 plus D0 is equals to, this is gone, this has gone, this has gone. D0 plus D0 plus D0 is equals to 7 into 0.6575. All that is equals to 52.03, which is the present value today. Take few seconds, calculate the D0 and give me the answer. I'm not supposed to teach you how to do it on calculator. I'm not supposed to teach you. Simply saying this value here will go towards the left and will be deducted. So 52.03 minus this present value, 70 into something, 70 into something, this present value will be 3 times D0. So 3 times D0 will be equals to 6 and D0 will be equals to 2. Are you people getting 2 as the answer? If you get it, kindly confirm. We need to quickly speed up now. Live people, recorded people, Sahil, are we set? Kindly confirm. Are you getting? Have you got 2 as the answer? Yep. I need to tell you 2 things now. 3 things in fact. Sir, it is very important to understand the marking scheme. How would institute allot you marks? Can I hear? How would institute allot you marks? Let me tell you. Institute will not check your answer at the end of every line, but they will check your answer at the end of every step. For example, for example, in this question, for example, in this question, for example, this question number 8 that we have just done. Institute will see that there are 3 steps, A, B, and C. There are 3 parts, right? And at the end of every step, they will check your answer. So suppose this was a question where we had parts. There are certain questions in which we don't have parts A, B, C. Rather, we have one ultimate answer. For example, imagine that there is a capital budgeting question. You would be able to relate to it since you are coming from C Inter. Imagine you have a capital budgeting question where you have to calculate NPV. So at step 1, we will calculate present value of cash outflow. Then we will calculate present value of cash inflow. So examiner, everyone in the class will check if your answer of present value of cash outflow matching. If yes, you will get that step mark. Is your answer of present value of cash inflow matching? If yes, you will get the marks. No, no marks. And accordingly, NPV will, if NPV is correct, you get the marks and no marks accordingly. Point is, how do you calculate the present value of cash outflow doesn't matter. You should make sure the answer of your present value of cash outflow should match. The calculation doesn't matter much. How have you solved that step doesn't matter. Answer of that step should match. Not just the final answer should match. Even at the end of every step, your answer should match. Once you realize this, you become free from burden. Because do you agree the same thing can be calculated in 2-3 different manner? Whatever way you find out. For example, beta. When we go to portfolio management, you will realize that beta can be calculated in 3 ways. Whichever method you follow doesn't matter, you will get the marks. Similarly over here, there is no particular step There is primarily only one step to be at the end, which is finding out d0, no other step. So how do you calculate the things in between doesn't matter. So long as your answer with the institute is matching, they are not concerned about it. This is very important for you to know, first thing. Second thing, sir, for example, you have written 52.03, then this, then this, then this. Sir, you have not solved this equation and directly returned d0. Institute has no problem with it. They don't want, like, we are smart enough that we don't waste our time, and even institute doesn't care if you have written down the steps in between or not. Once you have explained this, you have all your rights to solve it entirely on the calculator. If you have that intellect that, okay sir, this has become 1, this has become 1, this has become 1, which means sir it has become 3 times d0, which means all I have to do is that from the 52.02 I have to deduct this present value. If you can do it in your imagination, so basically answer will be d3 is equals to 6, for example. You don't have to show all this to examiner, you can directly say d0 is now 2, which means if you want to save time, which we will do in the class, I will teach you how to do it. We will become over the time brilliant enough to solve everything on the calculator itself. We won't waste time by writing much. Institute doesn't care, ultimately you should give your answer correct. Could I please explain to you these two things regarding marking scheme? And how will we have to save time? Not just this place, in the entire AFM, we will try to solve as much as possible on the calculator and directly write down the answer in the notebook. Requesting your response. Is this discussion making sense? Basically, the exam tips I want to share. People, are we set? Are we ready for this? Cool. The next one, everyone in the class, is question number 10. Let me check if this question is relevant or not. Hold on for a minute. It's a good question actually. We can consider solving this question because this question will help us teach a new concept. Do you know what is how do I decide the question? That's how do you people know that I have tried to eliminate all the duplicate questions from these notes. Almost similar question institute might have asked in 3 different exams. Almost similar. All of them have been merged in a single question. But if there is a unique question which tries to teach us something different, that is there in this notes, which is what the objective is, so that you can focus on the variety rather than blind hard work. Question number 15 will try to teach something new, which is question number 10 will try to teach something new, which is why we are going to solve this question. All right, not in the notebook, or we can consider solving it in the notebook as well. Acha, tell me one thing. Question number 9, we have done it in the notebook or on the calculator? Quick, please. Sahil, question number 9 was notebook or calculator? Quick, everyone. Other live people, recorded people, we have done it in notes now. Cool. So question number 10th, we are going to do it on the calculator so that we can focus more on learning. All right, please be here. This will automatically teach you a new concept. In fact, let me do one thing. Let me first teach you the concept and then take you there. So one way to calculate growth is this, which is retention ratio into ROE. All right. Coincidentally, the derivation of this was being explained to CFA students in yesterday's class. Coincidence? All right. Another way to calculate growth is using historical data. Let me now teach you. Imagine that we are standing at this point. Which point are we standing? We're standing at the end of 2019. We want to obviously calculate the value of share here, for which we need the future dividends. Basically, we need the future growth rate. Examiner has not given future growth rate, but he has given the data of past earnings or past dividends. Using the past numbers or past dividends, I can calculate the past growth rate, that what has historically been an average growth rate, and I can assume that growth rate to prevail in future years forever. Are you understanding? In future, till infinity, what is going to be the growth rate will be somewhere an average of past growth rates, is one of the ways to calculate if direct growth rate is not given. So now you are learning that of based on the historical data of EPS or DPS, how do you calculate the growth rate? And that same growth rate is assumed to prevail in future, which can be used for calculation. Let's assume that at the end of 2015, the amount of dividend which you distributed was rupees 200. In 16, you distributed 120 rupee dividend. In 17, you distributed 90 rupee dividend, then 140 rupee dividend, and then 150 rupee dividend. This is how the journey of dividend was from 2015 to 2019. Now we have to calculate the average growth rate of past years. Question is, how do I do it? As it is there in my nature, I can't tell you directly. I want you all to first think how can we do it, and then I will guide you. People in the class think, if you have the data of last 5 years dividend, how do you calculate an average growth rate of last like based on this data? Take your time. Think, everyone think. In fact, you know what? Today, I will give you a 10-minute break. An additional 5 minutes to think on this, which means in total you will have 15 minutes. In total, you will have 15 minutes, in which 10 minutes is the break and 5 minutes is to think how to find, is for you to think how should we find out the average growth rate. All right. You do it, come back with some answer, with some opinions, with some thoughts, and then we discuss how can we do it. Does that, everyone in the class, make sense? Hello, please. So it is 9:30 right now. I really want you all to think, otherwise don't start the lecture, recorded people. The objective for me is not to teach directly, but to teach how to think. So please be back by 9:30, 9:45. All right. Bye everyone. Let's meet back after the break. चलिए, so have you people think, have you people thought, I mean to say, are you people back first of all? साहिल says that सर फर्स्ट एंड लास्ट डे के बीच का डिफरेंस लेके डिवाइड एन कर देंगे तो आ जाएगा, या फिर फर्स्ट डे से एवरी ईयर का जी निकालेंगे और सारे का मीन कर देंगे तो आ जाएगा. फॉर दोज हु डू नॉट अंडरस्टैंड हिंदी, लेट मी एक्सप्लेन व्हाट इज ही ट्राइंग टू से एंड आई वुड अप्रिशिएट बोथ द ऑप्शंस. सर फर्स्ट वे टू थिंक is 100 is what was the dividend at in the year of 2015. Acha, first thing, before I explain, first of all tell me it is a growth of how many years. One thing you all should be obviously clear with is that if you have been given the data of 5 years, which means it has a growth of only 4 years. First of all, is it clear to you? 5-year data does not mean 5 years growth. Between a period of 5, in a period of 5 year, you can like it for a, if the data for 5 years is given, you can find out the growth only for 4 years. First thing. Second thing, second thing is that, sir, while calculating growth, one way to is do is that, sir, 150 has become the dividend, 100 was the dividend, and on 0.0 was the dividend, which means overall the dividend has grown by 50% over a period of 4 years. Dividend has grown by 50% over a period of 4 years, so divide by 4 will give me a growth of 12.5% every year. You know what is wrong with this? This is one of the suggestions. You know what is wrong with this? The point is that we have missed to see that, for example, what are you doing is that on a base of 100 you are considering a growth of rupee 50 on a base of 100, which is wrong. Because do you agree that every year the base will change? You are considering a one shot growth of entire growth of rupee 50 on a base of 100, which is incorrect. Because if you look at this part, this 10 rupee has grown, but this 10 has not grown on a base of 100, this 10 has grown on a base of 140. Similarly, this 30, this 50 rupees has grown on a base of 90, which means I cannot consider the base as 100 every year, which is why this method is not correct, because this is missing the compounding effect. Could I please explain to you all? Sahil, please confirm, could I explain why is this method invalid? Are you understanding? Your entire 50 has not grown on 100. Different years growth has grown at different bases. So one thing is clear, that method, first you thought is appreciable but cannot be applied. Second you said, sir, first year's growth is 20%. Second year's growth, for example, is minus 25%. Is it coming out to be minus 25? Yes. Third year's is growing to be something. Fourth as something. So I will add up all the growths and divide by 4 to find out the average growth. This was the second thought. Good. At least in this case, you solved that problem. The base is now maintained. For second year, when I say minus 25, I have considered 120 as my base, which is why I say that 120 to 90 give me minus 25% growth, which means that problem is solved. But again, here we are missing out the compounding effect. Compounding effect. How, sir? Let me explain to you. You are saying my capital has come down by 25%. Here you're saying that your sorry, not your capital, your amount. Here you are saying that my amount has come down by 25%. Here you are saying my amount has gone up by 20%. But do you realize? Again, while doing the average, we have missed the weights. Sir, listen to the criticalness of the situation, listen to the clarity of thoughts, listen to how your brain should evolve. How your brains should evolve, listen to this. Sir, if I understand my growth in dividend is 20%. I understand my dividend has fallen by 25%, but please listen to this. 20% has grown when the dividend was 100. 25% has fallen when the dividend is 120. Do you agree? While calculating the average, you missed the weights. As in, It has grown by 20, it has come down by 25, but at what weight has it grown or come down by? No. I think you didn't get it. Let me give you one more example. Let's assume a period of 2 years, 0, 1, 2. This is a precise example that will hit your brain. Let's assume that my dividend was rupees 50 at the end of at 0 point. It becomes 100 at the end of first year. It again becomes 50 at the end of second year. Give me what is the growth rate. Sir, for first year, the growth rate is plus 100%. For second year, the growth rate is minus 50%. Would you agree to it? 50 to 100 is 100% growth rate, 100 to 50 is negative 50% growth rate. Please do the method which you suggested. Please do a weighted average. Please do a simple average. Plus 100 minus 50 divided by 2. So basically 50 divided by 2 is 25% is the average growth rate. You are telling me if my dividend grows by 100% in the first year and negative 50% in the second year, then my average growth rate of 2 years is 25%. Please look at the data. Your dividend started from 50, it has come to 50. Is there any growth rate practically? No. Is it hitting you hard now, everyone? Is it hitting you hard? This is the beauty of maths, that, sir, you are getting 25% as your growth rate, but your amount has actually not grown at all. Why is this happening? I will teach you. When you say my dividend has grown 100%, it has grown on a base of 50. But when you say it has fallen by 50%, it has fallen on a bigger base of 100. While doing the average of 150, 100% and 50%, you missed that part. That 100% is the growth on what rate and on what amount, and 50% is a degrowth on what amount. Could I please convey to you why is even this logic incorrect? Everyone in the class. I need an answer of yes or no. Could I please convey to you why is even this not 100% correct? Then what is the point? Recorded people, anyone in the class, has anyone think of something else where we need to find out an annualized growth rate which considers even the compounding effect? You know what did this method miss? The compounding effect it missed. Sir, when 50 becomes 100, the next growth is received, the next growth or degrowth is received on 100 as the base, which means on this, see, when I say it is 100% return, which means on this 50, you earn additional 50 rupees to make it 100. Your next return should be on this 100, which means your next return should be inclusive of this 50 rupee. Interest on interest component, compounding effect, can you feel? Your next return will be on this 100, which is inclusive of previous return of rupees 50. Interest on interest compounding thing, which means what we need to apply is the compounding formula. Please listen to this now. Do you agree that this to you is a present value? Do you agree this to you is a future value? And do you agree present value into 1 plus a particular rate to the power n is future value? Where how much is my n in this case? How much is my n in this case? Sir, what is the rate? What is the rate at which if this 100 grows for a year of 4 years, it will become 150? What is the rate? What is the growth rate at which if this 100 grows for a period of 4 years, it become 150? Through this formula, can I back calculate this growth rate? Rate can be anything, interest rate, growth rate, inflation rate, anything. This is a basic formula. Any kind of rate you can put in this formula, I can back calculate the growth rate based on these numbers, which will automatically give you the compounding effect. Sir, if 100 is the present value, then 1 plus growth rate, which we actually need to find out, to the power, listen to this, 4 is very important to realize, है ना? All right, is equals to 150. Back calculating growth, sir, it is 150. Let me show you how do you calculate. It is like 150 divided by 100. So when you bring 100 here, it is 150 divided by 100. So you have 1 plus g to the power 4 is equals to 1.5. You will have to do the under root twice, under root, so that you can find out 1 plus g. So 1 plus g is basically 1.10668 something when you do under root twice. Now g is equals to what? G is equals to whatever value you are getting minus 1 will give you 0.10668 something, which is 10.67% as the answer. 10.67% is the answer. So G is equals to 10.67%. People in the class, are you settled? The point I want to teach you is that, remember, when you have data from 2015 to 2019, it is not 5 years, it is 4 years. Second thing, with this you can find out the compounded annual rate, which is the average compounded rate at which the dividends have grown. And I can prove it to you. I can prove it to you. Take your calculator, put 100 to it, add 10.67%. Again add 10.67%. Do it 4 times, you will automatically get 150 as the answer, which means this is the correct thing we have taken. Are you people clear with one more way to calculate the growth rate using historical data? Please confirm. Requesting your responses, please. Everyone in the class. Are the clarity of thoughts reaching to you? Quick. Sahil, are we set? Rest of the people in the class, are we set? Can we proceed? Yes. So I hope the presentation is clear that we stand here, we have the historical data, we have to find out the growth rate for future year. It is calculated assuming the growth rate of previous years. Just 1 second. I'm trying to present one more thing over here. Kindly considered. Cool. So I hope this way of presentation is making sense to you. Done. All right. Fine. Cool. So with that, everyone in the class, let us proceed to solve question number 10, which is to be solved in the notebook itself. I mean in the book, on the calculator itself, not needed to be solved in the notebook in the class. All right. Let us move to question number 10, which is a classwork question. Everyone, we will do quick, quick, quick. So SRK Limited is listed company, has just announced annual dividend for the year of 13-14. Sir, when they say they have just announced the dividend of 13-14, which means 13-14's dividend will be D0, which means we are standing at the end of 2014. Alright, cool. Earnings per share, dividend per share for the last 5 years have been given. EPS was 14, this. DPS was this. Okay, fine. In the opinion of MD of SRK, on the opinion of the company, if current dividend policy is maintained, annual growth of earning and dividend will no better be than annual growth of earnings over the past year. Take a minute to process this line. Take a minute to process this line, then I will explain. Read this line again. Quick, everyone. It says that if you follow the same dividend policy as you had in the past, if you follow the same dividend policy in the sense that if you distribute the same amount of dividend, same percentage of dividend, if you maintain the same payout ratio, then the growth of future growth of earnings and dividend, listen to the line carefully, then annual growth of earning and dividend, future growth rate will not be. Sir, how do you know they are talking about future? Or obviously they are using the word will. Dividends and earnings growth will not be better than annual growth of earnings over the past year. Meaning to say, in the past year, find out what was your earning growth rate. Not dividends growth rate of earnings they are saying. In the past, what was your earning growth rate? Find that out. And that will be the future growth rate of both earnings and dividends. Simple? Cool. Fine. Since the board is reluctant to take debt to finance growth, now since we want to grow, we would need more capital in the business, but we don't want to take the debt. We find it risky, right? It is considering changing its dividend policy by retaining 50% of its earning for investment in various projects. I will retain, I'm now planning to retain 50%. How much was I retaining in the latest year? For example, just for the calculation, see how much is the number. Sir, 8.2 divided by 14 gives me 58% of payout ratio. Minus 1 gives me 41% retention ratio in the past. For the latest year, I'm saying. I am now planning to change it to 50% retention. Why? Because I need money. If I retain, my company will have more money. And by retaining this, and if I have more money, I would be able to invest it somewhere. So by retaining this, I will invest in the project where my return from that project will be 15%. ROE, return from the project where this amount will be invested will be 15%. My beta is 1.5, market risk premium. RM minus RFF 4%, risk-free rate is 6%. What an amazing question they have given. What do they want us to calculate? You are required to calculate expected market price if SRK does not announce change in dividend policy. If there is no such announcement, then what will be the share price? Sir, they have given you a clear hint that whatever is the growth rate of EPS in the past year will be the future growth rate of earnings and dividends, which means if I want to do D1 divided by K minus G to find out the share price, D1 I can easily find out. Latest dividend is 8.2 into 1 plus growth rate will give me D1 divide by. How can I find out the K? You have the data of RF, RM minus RF, and beta will give you the K minus again the growth rate, where the growth rate will be this. Let us start using your calculator very quickly. D0 of 8.2 is available to you. Let's find out the growth rate. People in the class, let's apply that compounding formula. Future value is equals to present value. So let us write it this way. Present value into 1 plus growth rate to the power n. How many years? 1, 2, 3, 4. To the power 4 will give me 14. Please remember, earnings growth we have to take over the past years, which gives you due as what? Use your calculator. 14 divided by 12.2. Whatever you get, under root 2 times, because it is to the power 4. Under root 2 times minus 1. How many of you know this logic? How many of you know this logic? Let me tell you. When you say 12.2 into 1 plus growth rate to the power 4 is equals to 14, it is like 1 plus g to the power 4, obviously 14 divided by 12.2. Next step is important. Do you know it is like 1 plus g is equals to whatever your answer, 14 divided by 12.2. It's like this. What is here to the power 4 in the LHS, if you take it there, it becomes fourth root of this number. Basically it is 14 divided by 12.2 to the power 1 by 4. Simply saying, what is towards the left as to the power 4, when you take it towards the right, it become to the power 1 divided by 4. You know the simple mathematics? Just in case someone doesn't know, I know a lot of people would know it. Anyways, what are you getting as the answer is my question. What are you getting as the growth rate? Waiting for the answer. Please, 14 divided by 12.2 is equals to under root minus 1, gives you 3.5% as the historical growth rate, which will be assumed as future growth rate as well. Are we done till this point? Yes. Let us now calculate KE. RF is 6, RM minus RF is 4, beta is 1.4. So 1.5. So 4 into 1.5 is 6 and 6 plus 6 is 12. So 12% is KE. Very quickly calculate the share price. Please. Latest dividend was 8.2 into 1.035 growth divided by K minus G 0.12 minus 0.035. What are you getting as the answer? Please share it to me, everyone. Recorded people, live people, use your calculators to show me what is the answer. Quick, waiting for the answer. I'm sorry, I think the 99.85 is being told as the answer, which is fine. Answer to part 1. Sir, calculate the market price if the company announces change in dividend policy by retaining 50%. If the retention ratio will change to 50%, what will happen? A very important question. Let us figure out. If I will retain 50%, what will change? Will my D1 change? Yes, it will change. If I retain 50%, will my D1 change? Yes, it will change. Will my K change? No. K is my required rate of return. That does not depend on my dividend policy. That depends on the risk taken. So K will remain the same. It will not change. Will my growth change? What do you think? Because of change in retention ratio, will my growth change? Everyone, I need an answer. It will change. Listen to the first line carefully. If dividend policy is maintained, then this will be the growth. If the dividend policy changes, then the growth rate will also change. What will be the new growth rate? Sir, retention ratio into ROE. Everyone in the class, there are only two ways to calculate growth, where they have given the hints of ROE as well. So 50% is retention ratio, 15% is ROE, 50% into 50% is 7.5% growth rate. Think about the revised dividend. Do you agree? I need to find out new EPS. I need to find out first year's EPS, of which 50% will be dividend. How to find out first year's EPS? I have 14 rupees as the EPS of 0 year. So 14 rupees of EPS into growth rate of 7.5% will give me EPS of first year. Multiplied by 50% will give me dividend of first year. Yes, no. Sahil, what are you saying? Yes, sir, that example in notes I remembered. Which example? Okay, okay. Example of growth. Great. Chaliye, let us proceed to solve this question ahead. Please remember, you cannot make this mistake. What mistake? See. In your notebook, write it down. Don't do. What do you have to not do? Listen to this. What do you have to not do? Listen to this. Some people might consider D0 as 8.2. So don't take 8.2 into 1.075 as the new growth. Don't do this. Because you are saying that this was my latest dividend. To the latest dividend, if I add a growth of 7.5%, this was my D0, I will get D1 as this. Please. You need to understand something. Because you don't realize the depth with which concepts are applied in the question. You have to recollect the concepts which were learned. Can anyone in the class tell me why can't I do this? I don't like to teach the correct things. In fact, I like to teach why is something incorrect. And that is when a student evolves. Why is this incorrect? You need to tell me that. Everyone in the class, why can't you do this? I know you will make a mistake. I have taught you this concept. Sir, if it is D0, why can't I simply add my growth to dividend? Oh ho. Sahil, this is ultimate, this is brilliant. All the students who have literally thought, sir, why can't I find even from this? Because my payout ratio has changed. Brilliant people in the class. If the payout ratio changes, where is that? Oh, beautiful. Your earnings will grow by 7.5%, agreed. Why do I assume that even dividends will grow by 7.5% if the payout ratio is changing? Can it grow? It cannot. Payout ratio has changed. Earnings growth is needed to be calculated, of which revised 50% is needed to be calculated. Let us proceed. Sir, 14 is my earnings. My earnings, one second, 14 is my EPS. Earnings will grow by 7.5%. You will get even. And from that even, you have to apply 50% payout ratio to find out D1. You cannot directly find out D1. This is the clarity of concepts. This is the application of concepts. So please write it down. Don't do this because payout ratio is changing. Because payout ratio is changing. All right, this concept gets applied here. So what is the solution to this? Solution to do is that from E0 you go to E1 and from that you go to D1. Whenever there is change in payout, you cannot follow this path. You can't do this. But yes, you can do this. I hope the presentation is making sense. And if the presentation is making sense, let us very quickly proceed. Which brings me to one more conclusion, if you don't mind. I don't know what is happening to me, but I want to share whatever I can share, whatever I feel like sharing. Everything I feel like sharing, I'm sharing. Can I proceed to share one more thing before we proceed to solve this question? Everyone, very quick. We are lack of time. Which means we need to go to outnotes, and this is the formula of growth. This is the formula of growth, not of dividends. This is everyone in the class formula of growth of earnings. This is the formula of growth of earnings, correct? If the payout ratio is constant, assume it to be the growth of dividend as well. However, in this case, since the payout ratio has changed, I cannot assume it to be the growth of dividend as well. Are you logically clear? This is the formula of growth of earnings. ROE gives you return on earning. You remember the logic. Sir, this much I retained, and on that retained portion, I will earn this much, which means ROE is based on EPS. This is the formula of growth of EPS, not dividend. You can assume it to be the growth of dividend if the payout is constant. This is the depth of the concept. Great, amazing, brilliant people in the class. I hope you have updated this. Just write down one more thing. Just 1 second. Let me write down. Beauty. Beauty. Which means I don't want to leave you in any question untouched with the depth of this learning. All right, cool. So we have found out the revised. Where is my revised EPS? This is here. This is 14% into 1.075 ka growth. And once you get even, 50% of that will be the revised EPS. So 14% into 1.075, whatever is the answer, into 50%, which is 7.525 rupee, not percentage. There are small, rectifications like this, which I will try to do in the class, but if I miss to do it, kindly consider this understanding. And obviously, we are learning it in the manner that you can do such rectifications at your own. So 7.525 is the revised D1. What is revised growth? You have what is the revised K, which is the same as older one. Find out the revised P0. We are done with this question. Everyone in the class, please operate your calculators. 7.525 divided by K was 12%, revised G is 7.5, which means 0. Divide by 0.45, 167.22 rupees is the revised value. Done? So I hope the conceptual clarity has reached to you. This question has only been asked in an MTP of May 2015. No such question has ever been asked in the exam, or it was there in the study material, nothing like this. However, I found this concept to be taught to you, which is why I wanted to discuss this particular question with you. All right, amazing. We are done with question number 10. If you feel like us, if you feel like, sometimes I like to mark things, so you can mark that this particular concept is of use. Where should I mark you this? So write down over here that this concept that you are learning is being applied to question number 10. All right, fine. So we are all set. We have spent sufficient time to apply the concept we learned over there. Question number 10 is done. Question number 11, an extremely easy question. You will have to do it at your own. Not at your own. I will have to make you do it. So please do a rectification. Basically, this is not part B. Part B is this. This is actually a continuation of the same question. This basically per year and perpetuity. This is in continuation. A and B are only the two parts. All right. Just hold on for a second. Let me have water. Then we explain. Then we focus on understanding question number 11. Take a quick 1 minute breather break. Shall we proceed, everyone? Question number 11. So obviously slightly we are leveling up with time. Question number 11 is another next level question that you need to learn because this question will again teach us something in particular. I am marking it to be the classwork question. Let's proceed for question. Sir, in December 2011, all right, AB company share was sold for rupees 146 per share. Okay. The share of the company was being sold for rupees 140 per share. All right, fine. A long term earning growth is 7.5 is anticipated. So we have price of the share already given, we have a long term growth rate already given. Company expected to pay a dividend. D1 is given as 3.36. All right, so we have P0, we have D1, we have G. What is the rate of return an investor can expect to earn on earning, assuming dividend are expected to grow along with earning at a rate of 7.5 per year in perpetuity? Listen to this. Long-term earning growth rate was 7.5, right? And in the question, they are saying that dividend will also grow at the rate of 7.5, right? Because they want us to calculate the return an investor can expect to earn. Sir, they are asking for expected rate of return, not required rate of return. Oh my God, what are you saying? They are, one second, there's some background noise disturbance, wait. Anyways, ignore. Sir, they are asking you to calculate expected rate of return. But KE is called as required rate of return. What is happening? For that, let me again take you concepts notes. You remain there. I will just teach you from here. It is not needed. See, the details of whatever I'm speaking will be shared to you in portfolio management. Whatever I'm speaking to you, the details of this will be shared in the portfolio management, but you on a lighter note need to understand one thing at this point, that expected rate of return and required rate of return. Expected rate of return is denoted by expected rate of return particular security I. Required rate of return is denoted by RJ. Although these two things are completely different, we have learnt it in the basics of AFM. Require is how much I need to earn based on the risk taken. Expected is how much I think I will be able to earn based on my estimate of price and dividend. These two are different. However, logic I'm not explaining directly. The conclusion I want to share that, sir, if my share is fairly valued, if my share is fairly valued, which means if my P0 is equals to IV0, if my share is fairly valued, then expected rate of return and required rate of return are same. Which means if my share is fairly valued, I will be able to earn my expected rate of return. I will be able to earn how much I require to earn. If I require to earn 10%, I will be able to earn 10% only if the share is fairly valued in the market. If I buy that share, I will be able to earn how much I require to earn. Which is why everyone in the class, most important line, these two terminologies will be used interchangeably. Can I use expected rate of return in place of KE? Ideally, no. But if the share is fairly valued, these two are same. Hence, examiner will give you expected rate of return and ask you to calculate intrinsic value. Sir, how do I do it? Because I need required rate of return KE. You can use even expected rate of return as your KE and solve the question, is what I want to tell you. In place of K, you can even use expected rate of return because the examiner will automatically assume the share to be fairly valued and both of them are same in that case. क्या मैं आपको बहुत simple, could I everyone in a very simpler language explain you this? Quick yes or no I need. People, right? Now, 1 second, people, I need to look at Sahil. I'll look at your query after a few minutes. Let me complete this. Which is why this conclusion is important. Whether they give expected rate of return or required rate of return, you can consider it to be your KE and solve the question simply is what I want to tell you. All right, this is fine. This is fine. Which means now we realize that all right, even if they ask you expected or required, you have to calculate KE. One thing is clear. Now let us proceed. When you calculate KE, there are different ways. First, CAPM. Given the data, can you apply CAPM? No, sir. No RFRM given. What was the next priority? Sir, Gordon's model, that was D1 divided by KE plus G. Which growth rate do you need? Growth rate of earnings or growth rate of dividend? Clarity of concepts, tell me which growth rate do you need? Dividends, right? What has examiner given? Growth rate of earnings. In the part A of the question, he has clarified that even dividends will grow at this rate, which means you can consider 7.5, which means D1 divided by P0 plus G, 7.5% of growth you can consider as dividend as well, and hence can be considered in the formula of K. Which means automatically can I conclude that my payout ratio would be constant? My payout ratio would have been constant so far, which is why payout ratio and earnings payout ratio and dividend I mean the growth rate of earnings and growth rate of dividend is turning out to be the same. Yes, everyone, this is the clarity. All right. So let us proceed to solve this question on the calculator itself. Please use your calculator to find out KE. Let me tell you, even if you don't think all these things, even if you don't think that earnings growth, dividend growth, what to consider, what not to consider, even if you don't learn on this, you will be able to solve a lot of questions, but not every question. And that is what the difference between a student who is studying directly from the study material or who is taking, let me very clearly tell you, who is taking even the regular batches available in the market. With this clarity, it is not being taught in even the regular batches what you're learning in the fast track. And that is what will make a difference between you and a student in general, that okay, I need dividend growth, here earnings growth is given. Let us over here institute has explained that it is dividend growth. Even if they don't explain, I will assume, but it's not getting assumed out of ignorance. I am intentionally assuming it using my knowledge that okay, I need dividend growth and I can assume it. When they have given the dividend growth rate to be 7.5, again it is your knowledge, not your ignorance, which will tell you that okay, which means payout ratio would be same, which is why they are assuming so. This is the clarity. All right, so please be here. Sir, let us calculate. See, again, if there would be students studying from study material or in general, he will just be directly taught that expected and required is same. No bro, they are different. When the share is assumed fair valued, they are assumed the same logic I will teach you in portfolio management right now. You should be just settled that we are not assuming things out of ignorance, we are assuming them out of knowledge, understanding, clarity of concepts. All right, cool. So let us proceed. Sir, K is D1 divided by everything. So 3.36 is D1. Use your calculator, divide by 146 is the price, plus 7.5 growth rate of your dividends. All right, cool. Quickly, what do you get as the answer? 9.8 is being spoken as the answer in the chat box. Are we all set at 9.8? Cool. Next part is what I have brought you, why we are doing this question in the class. It is expected that AB company will earn about 10% on book equity. Can anyone help me understand this line? Because if you understand, it is my salute to you. It is expected that company will earn about 10% on book equity. What do you think? What is 10%? What is your return on book equity called as? Think. What is that formula of return in which book equity is the base? Return on equity. Didn't I tell you multiple times that ROE is a ratio based on books, based on balance sheet, where equity book value is considered as the base. ROE is 10% and shall retain 60% of earnings. Oh my God. Companies now planning to change something. Company will earn 10% and it will retain now 60%. In this case, whether there would be any change on the growth rate? So obviously my growth rate will change. My growth rate will be 10% of book equity into 60% of retention rate. It will be 6% of growth rate. Oh my God. The growth rate which was 8.5, 1 second, 7.5, and I cannot compare it with the dividend growth rate. This formula is growth rate of earnings or dividends? Earnings. So growth rate of earnings which was 7.5 will now be 6%. Everyone in the class. Will the growth rate change? Yes, sir. Because of change in growth rate, will your cost of equity change? Yes, because when I do D1 divide by P0 plus G, where my D1, for simplicity, I'm saying my D1 was 3.36 divided by P0 is 146. Now the growth rate will be 0.06. Will my KE change? Obviously, it will change. But not only this much, it will change further. Do you agree? Because of change in retention rate, since I will now retain 60%, since my D1 will also change, requesting your response, I cannot use this is why we are here in this question. I cannot use the existing D1. I will have to calculate the revised D1, which will be based on 60% growth rate and 6% earnings growth. 60% payout ratio, sorry, revised D1 which will be based on 60% payout ratio and 6% growth rate. Requesting your response, everyone. This is the ultimate depth in this question that I will have to use revised D1. How many of you are able to process about this thought? Let me clear to you. I have been given existing D1. Existing D1, everyone in the class, is based on some payout ratio that I don't know, which means my revised estimate existing, see, basically D1 and E1, whichever is, whatever is here for the next year is my estimate, I don't know. But my existing E1, everyone in the class, is based on my existing E1 is based on the growth rate of 7.5%. Now a situation is changing where my growth rate rather than 7.5 will be 6%, and whatever becomes the revised even of that, 40% will be payout, because 60% is retained, 40% will be payout, and that will be revised D1. I cannot simply add the growth of dividend growth and the dividends. Whenever the payout ratio changes, people in the class, do you realize I cannot calculate D1 from D0? I have to go through earnings. Requesting your response, could you understand it or not, everyone? Cool. Because the growth rate will change, which is going to be 6%. 1 second. See, E0 never changes. We have earned it. This has happened. This is history. It cannot be changed. It is past. What I can change is my future. So in future, I was expecting I will earn even. That was based on 7.5% growth rate and a particular payout ratio based on which this existing dividend of 3.36 was being calculated. But because of certain things being changing, my growth rate will change to 6%, and even my payout ratio, everyone in the class, will change to 1 minus 60%, 40%. Chalo. Let us simply say 40% will give me revised D1. That is how the flow should be. Could I explain to you this with complete clarity, where on my timeline it is 0 year, it is 1 year. Where I stand, I stand here and I was estimating future and now I am estimating this future. So when I go to calculate KE, it is D1 divided by P0 plus G. Point is G is 6%, which has changed, but even my D1 will change is the point. How do you calculate this D1? Let us understand. So do I have this D1, 3.36 rupees? Yes. Which means can I back calculate somehow what would be my existing E1? Because if I get existing E1, I will eliminate from that 7.5% growth and I will add 6% growth to find out revised even, and I will find out 40% of that as revised even. All I need now is existing even. That what would have been the even, present even now. Let's guess, let's guess. What do I need here? From D1, if you want to find out even, what do I need? I need payout ratio. Is there any way to find out existing payout ratio? Think. Is there any way to find out existing payout ratio? Because if you have payout ratio, you would be able to get EPS, existing EPS of first year. Sir, my existing growth rate is 7.5%. Do you agree existing growth rate of 7.5% will be ROE multiplied by existing retention ratio? So listen to this carefully. Listen to this carefully. Sir, my existing growth rate is 7.5. So if I know that growth rate of 7.5 is actually equal to ROE into retention ratio. If my ROE is 10%, then can you back calculate the retention ratio? Obviously, 7.5% divided by 10% give you 75% of retention ratio. Which means, can I say, see, existing growth rate is based on existing retention ratio. So obviously, from 75, the retention ratio will change to 60%, which is why payout is 40 now. Right now, if retention ratio is 75%, means the payout ratio is 25%. Can I now back calculate existing EPS? What would be that EPS? 25% of which is 3.36. Sahil, if you are able to think is this in this manner, it is highly appreciable. Could I literally explain this to everyone? If I have ROE with me, if I have growth with me, existing growth and ROE, see, ROE does not change. Is it in your hand to change ROE? No. You cannot very easily change ROE, but the dividend policy, which is payout ratio and retention ratio, you can change. That's a matter of policy, that's your decision. Which means if I have ROE which does not change in general, if existing growth is based on existing retention ratio, existing growth I have, which means existing retention ratio is 75%, this is what it is. And which means existing payout ratio is 25%. I want you all to use your calculator. Imagine this. If payout ratio is 75%, please back calculate, sorry, if payout ratio is 25%, please back calculate existing EPS. So 3.36 divided by 25% gives you 13.44 as existing EPS. If 13.44 is existing EPS and that comes after 7.5% growth from 0 to 1 year, can you tell me what would be EPS at 0 point? Can you tell me what would be EPS at 0 point? Those who are thinking it is 30.44 minus 7.5%, they are thinking it absolutely incorrect. It is not a growth of 7.5% to be deducted from this. It was a growth of 7.5% which was to be added on this. Which means, let me tell you, EPS 0 will be 13.44 divided by 1.075. Everyone in the class, do you agree that EPS 0 into 1.075 was equals to EPS 1? So if you have EPS 1 of 13.44, EPS 0 will be 13.44 divided by 1.05 number. All right. So 13.44 divided by 1.075 gives me 12.50. And once you get your existing EPS, now the life is sorted. Let us add 6% growth to it. So 12.50 into 1.06 give me 13.25 as my revised EPS. And because of revised growth, my EPS has revised. And of this revised EPS, if I distribute 40%, which is 5.3, everyone in the class become my revised dividend. And do you realize this is what was needed for me to calculate KE? Everyone, to me, more than writing down the stuff, understanding is important. Are you now realizing why is it not important to write down? Because if I focus on writing down such things in the notebook, will I be able to focus on explaining these things in such details? Considering I want to tell you everything more than your regular batches in just a period of 200 hours, if I have to deliver everything, I have to restrict myself somewhere, right? So if you have D1 of 5.3, now you don't need me immediate give me an answer of KE. You have D1, you have revised growth of 6%, you have P0 of 146, answer is 9.63 as someone is giving in the chat box. Please confirm. I hope live people, recorded people, we are all set with this. Question number 11th. Complete clarity, complete comfort. Sahil, can we proceed? Rest of the people in the class. Yes. Are your brains working or are you people exhausted? I think we have leveled up in today's class. The first two classes were quite easy. You must be wondering it's like CA Inter. But slightly we are leveling up and we are ultimately going to level up to an extent that you will feel that, sir, this is now the quality which we are covering things. Question number 12, homework. Easy question. Even 13th question is your homework. Even 13th question is your homework. The point you need to understand in question number 13th, I will share it now. Generally, it does not happen in AFM. Generally, it does not happen. However, there are certain rare instances where such things are being explained. Let me share it with you. Sir, question asks you to prepare income statement. So let's do one thing. Let us go to Outnotes and let us create a format of income statement which will be needed for you to know. All right. Where, on which page? So I can find out a page available for us on. So before your first page where you are learning basic ratios, can you be there? Before that page you will find a blank page. Let us prepare a format of income statement over here. The basic format needed for AFM for income statement is like this. Sir, you have revenue minus COGS. Follow me, as in you don't have to follow me. You have to rather lead me. All these things must be clear to you from C enter. What you get is gross profit. From the gross profit, if you deduct selling, marketing expense, or if you deduct admin, general expense, what do you get? If I deduct this and this, EBITDA. People in the class, do you know what is EBITDA? Earnings before interest, tax. EBIT you already know, EBIT, EBIT, earnings before interest, tax. Depreciation and amortization, which means if you from your profit do not deduct even depreciation and amortization, the profit you get is called as EBITDA. Which means let us from this topic deduct depreciation or amortization, and when I do so, what I get is called as EBIT, which is also called as operating profit. Everyone in the class, what is EBIT also called as? Operating profit. From this operating profit, from this EBIT, the next thing obviously you deduct is interest, which means what you get is profit before tax, also called as earnings before tax. Obviously, from this, if you deduct tax, what you get is profit after tax, earnings after tax, also called as net profit. Which means examiner can give us different kinds of profit terminologies that we should know. We should know that what is gross profit, what is EBITDA, hold on. We should know what is gross profit, what is EBITDA, what is EBIT, what is PBT, what is PAT. There is a further thing to be considered in the income statement, further calculation, which I would show it to you over here, but actually the income statement ends here. After that, obviously we deduct certain things like let me show you, like, which is why I'm showing you that in blurred. Preference dividend, when you deduct what do you get? EAS. That we have already learned in the basics, huh? That we have already learned in the basics. From EAS, if you deduct equity dividend, what do you get? Retained earnings. One second. Let me make the presentation casual for you all. I actually take time to present things, let me tell you. But I try to make sure that the presentation is very precise. So tell me, my actual income statements ends here. But for the purpose of AFM, we will a lot of time, almost every time will need to do calculation like this. So for us, this also become a part of income statement, which means from sale to retain earning, if I have to go to, this is the way. Are you people clear with this format of income statement? In fact, all of you need to first of all tell me, was there anything new in this to learn? Why did I not focus on explaining and only writing? Because this is quite obvious, you should be knowing. Was that obvious for you to know? Kindly confirm it once. Yes, all right. Of which, if you realize, this much part we have already done. The very first thing in the basics we read was EPS, which was simply this thing, right? So this we have done, still we are now further clear. Let me now further tell you a few things. Sir, COGS and selling expense, admin expense, depreciation, all these things, all these things are collectively called as operating expenses. In general, when someone says operating expense, you have to understand that is an expense for maintaining or for related to your operations, which is all the operating expense. Because after that is interest, which is a financing nature of expense, not operating nature of expense. And that is the reason everyone, this profit is called as operating profit, if you realize. One second. That is the reason from the revenue, if I deduct all my operating expense 1, 2, 3 and 4, obviously the profit I will be getting is operating profit, which is also called as EBIT. This is the clarity with which I wanted to teach you income statement. Are you people 100% comfortable? Now you are clear with the possible names, possible terminologies, everything related to income statement. Alright, cool. Next one. So when I go to Outscanner, question number 13 asks you to prepare an income statement, which means you have all the data based on which income statement is needed to be prepared. When you prepare the income statement, you will realize that sir, revenue itself is not given. I'm trying to give you the hints. You will have to solve this question at your own. I'm trying to give you the hints. Sir, if you talk about total asset and total asset turnover ratio, how many of you remember the formula of total asset turnover ratio? Kindly respond. I'm waiting. Formula of total asset turnover ratio, everyone in the class. It is revenue divided by average assets, and if average assets are not available, closing assets. So if I have total asset turnover ratio as 1.1 and if I have total assets as 600 available to me, can I back calculate the revenue? So this way you will have to use different ratios to ultimately calculate numbers. Similarly, when someone says operating margin is 10%, which means of my sales, EBIT is 10%, which means operating expenses would be 90%, correct? Operating expenses would be 90%. This way you would be able to prepare the income statement. All right. So just before we end the lecture for the day, let us do one more thing. One more thing would be going to the outnotes. We have a specific page where we need to write down all the formulas, where the first formula we need to write down is asset turnover ratio. Revenue divided by average asset. Basic, simple. Second formula, don't write it down here because I know a specific formula that will come here. On the next page, write down operating margin. In fact, let me use the word sales because revenue word is actually not being used in AFM in general. All right. So sales divided by average asset and operating margin divided by sales. Abhi gross profit margin or the gross margin will be gross profit divided by sales. So as we do further question and as we find technical formulas, I'm on page number 8 of the outnotes, people in the class. As we come across more formulas, we will continue to write them down over here. All right. Assuming you are done, quick. Assuming you are done, I want to take you again back to the income statement where along with revenue, I want you all to write down the sales as well over here, which is fine, easy, basic thing. So when you have this, obviously you should be able to solve this question, in which last thing I want to tell you is effective interest rate. In the subject of FR, now you all know what is the concept of effective interest rate, right? Which means the actual interest rate are not considered for the purpose of income statement. Rather, on that amount, whatever is the effective rate of interest is taken as an expense to income statement, profit and loss. So my total amount of debt is 175, of which these are not considered expense, rather 8% is considered expense to find out the interest, which is to be deducted from EBIT. When you solve this question, you will automatically understand what this is about. So I think we have done sufficient amount of noting to be done for this question. Question number 15 is an ambiguous question. We will figure out what to do for this question in the next class. Everyone, are we done for the day? Are we set with whatever learnings we have? The next class obviously will be through the software, not on YouTube. Let me check your query. Okay, Sahil, don't worry at all. I will ask team to share the things, all right? To share the serial keys and everything with you, and next class onwards we'll have all the lecture on the software only, all the live people, all right? Great, fine. So I hope your learning experience is really good. I hope you people are liking the lecture. I hope you people are liking the approach, the depth, the language, the speed. If in case anything is lacking, you have all your rights to give the feedback. It is a live batch. Whatever feedback you feel like giving to me, you can, and we can try to implement those things in our batch. All right. Cool people. Thank you so much. If there is any feedback, you may share to me on WhatsApp or Telegram or whatever. I'll make sure that your learning experience is good. All right. So take care. Bye bye. Thank you so much. Thank you for being live, especially. GD people, thank you for watching it up. I'll see you in the next lecture. Bye bye.